This episode of Market Talk is brought to you by Growmark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And joining us now to take a look at the market trade on Wednesday, Mike Zuzolo, Global Commodity Analytics, is with us. Mike, good to catch up with you, sir. How are you?
Doing great, Jesse. Thanks for having me back.
I appreciate the time, Mike. And Wednesday, started out with a lot of gusto, led by that wheat market, and then we just kind of fell apart. Quarter beans, especially, ended up low range closes. The wheat market well off the highs. I know a lot of news, a lot of chatter out there, but overall, you're just as you step back and look at this grain market, it just felt like a clunker of a day on Wednesday, Mike.
It really did, and I think to oversimplify it, I think you had some really strong news out of Ukraine. But if you were watching the crop conditions closely, and most of us were on Monday night, now Tuesday night because of the holiday, we really wanted to see a decline in the corn and bean ratings and the good to excellent. Not a big decline, but at least a decline. And we didn't get that. Everything remained unchanged. And you could argue whether that's right or wrong, but be that as it may, whether it's right or wrong doesn't matter. I think that pinned the row crops up against the wheat because the wheat had the good news. Even though a lot of this Ukrainian news will eventually spill over into corn because Ukraine ships about as much corn as it does wheat, if not a little bit more in percentage terms than especially Russia, countries like Russia. So I think it was a defined market where the wheat got the good news, didn't get hit by the crop conditions, and the spread traders kind of reacted that way. And especially the spreading seemed to kind of exaggerate itself or accelerate itself, Jesse, when we went up against some key resistance levels in both D's corn and Nov beans. And I was really shocked for what would normally be a light trading day after a holiday. I think we had a 52-cent range in November beans.
Yeah, it was unbelievable. It was really a wild day. We're going to get to that in a second. I want to start, though, and focus in a little bit more on the wheat markets and look as well at another new high in the U.S. dollar. Again, we've been seeing highs day after day, it feels like, Mike. And then, you mentioned Ukraine, the news with Putin talking about the Ukraine grain deal. Seems like he's got a little beef against it or something or other. But that really just kind of set us skyrocketing here on Wednesday morning. So talk a little bit more about this situation and how wheat and the dollar are kind of correlating right now.
Well, late last week, I had done some talking and some interviews and also had written to clients and subscribers. What you're looking at here is an annual soft red wheat chart. So each tick is 1 year. And last week when we went home for the holiday, the price of soft red wheat currently was almost the exact same price is where we had opened up for the whole year of calendar year of 2022. And I had talked about and written about the idea that we really aren't looking at the Ukrainian situation. We're looking at it through rose-colored glasses instead of practical and an application based upon what's going on with natural gas. In other words, Vladimir Putin, if you would take a playbook or a template and use his natural gas template and slap it on top of the wheat, it would be a war of attrition, a war of supply, and not allowing supplies get to the European Union. And I've been baffled why he hasn't done this sooner. I think it's been mainly because of pressure in the political atmosphere from a standpoint of how he looks to the world. And so when he came out today in the overnight markets and said that he really doesn't need to trade with the Western countries, he thinks that most of the wheat leaving Ukraine is going to Europe, not to poor countries. And he really wonders about the grain deal. And he's going to talk about that with Turkey's president at the end of this week. I think it really made a lot more sense to me what is really going on over there in Ukraine and in the Baltic regions. And so that soft red wheat was able to rally sharply. And you see the contrast between it and that orange line, which is the U.S. dollar. and the US dollar made a fresh 20-year high in its index. We made a fresh 24-year high against the Japanese yen, and the British pound. We're now at the strongest point against the British pound since 1985. And what you see in this chart, Jesse, is typically an opposite reaction. These two assets move opposite one another, and that's a key part of the analysis. And this is in part why I think wheat tends to lead corn pretty frequently historically. What you have now is both going up, and they're both going up for the same reason. The wheat is being bought now because of the Russia-Ukraine situation turning sour because of Russia's mindset, and the dollar's being bought because of the Russia-Ukraine situation and the geopolitical safe haven buying. And something's going to have to give if you look at it historically speaking. Either the dollar's going to back down or the wheat's not going to have the legs to go higher. My sense is that Putin is not going to back off of this situation, and he's going to be more like natural gas, hard line, shut it down, and then all of a sudden you have the wheat market moving higher. So I'm watching to see if the dollar doesn't signal that maybe I'm on the right track by maybe softening up and maybe even giving us a technical sell signal on the weekly charts.
Well, Mike, let's flip over to soybeans. Rough day at beans on Wednesday. Outside day down, it looked like on the charts. I'm going to pull up another one of your charts that you shared with me, a soybean continuation chart for the month. And really just looking at the bean complex after Wednesday's close and Wednesday's action, I'm a little scared about what's going on in this bean market right now, Mike.
This is a really rough looking chart right now, Jesse. If you take out that blue trend line that we're closing on again, this will be 3 straight months that we've tested this uptrending line. And even though the line's a little bit off on the bottom, it's being drawn off the 2021 low, and you could even extend it all the way down to the 2020 lows. And you notice also at the old point of the wedge in the prior sets of blue lines, there's a dotted green line that kind of shows you the apex, or the what I would consider the equilibrium price in the trade, technically speaking. And it all comes together pretty closely within 25, 35 cents of one another. The bottom of the chart is an oscillator, which suggests a sentiment for the funds, and it's already turned into a sell signal as of the last month or so. So we're in a sell signal, pretty deep sell signal, technically speaking, on the sentiment and the oscillators. And really the last stand we have, it's kind of like General Custer fighting Little Bull. The only thing we have at this point is that blue trend line that, as I said, was when we closed today, we're testing it again. And this being a brand new month, it would be very negative, in my opinion, to take that out in a relatively strong volume type trade. If we did, I'd have to get back onto the hedge mindset, because if you notice something about the beans from 2014 and that rally all the way to 2020's bottom, you really didn't leave a trading band of an 840 support, a 1040 resistance, and kind of an equilibrium price of 940. And at some point, especially if Brazil produces 150 million tons of beans and China's economy continues to stay weak, I think at some point we're going to have to head back towards that $11, 1040 area. And I think we really have to be on point for that, because if you look in the past, if you look at 2020, if you look at 2014 and that high made back in the second quarter, it only took us 4 months to get back to 1040, and we were trading almost the exact same price we are today.
Well, Mike, as well, I want to rope this in with the whole dollar discussion too. I know the news out of Argentina, the policy there, 200 pesos to $1, trying to encourage soybean sales. Feels like that's a Band-Aid on their economy. And you mentioned China and some of the weak economic data, recession fears that are out there. I think this all kind of ties back to a lot of the things going on in the macro markets as well that we have to watch out for. Some of these, countries with dollar-denominated debt, that's a little bit scary as well in the grand scheme of things right now.
Yeah, it really is. And this goes to your point about what you just said. This is why Argentina's government's doing what it's doing. There's a presidential election. They're trying to buy votes, but more importantly, they're trying to add dollars to their currency reserves because their debt load is getting unfathomable, and they can't take much more. And it's interesting when I saw the story, and you were right, Jesse, to say it was 200 pesos to $1. But really, to a farmer, that means nothing. You've got to export the soybeans. So it's really 200 pesos to a certain amount of soybeans that you're willing to let go of during the month of September, instead of the normal price of 139 pesos to the dollar. And if you think of it in that way, it strikes me that the Argentine farmer will probably bite into this apple very aggressively the first week, 2 weeks maybe, of this policy for the month of September. But I think he'll go back to doing what he was doing previously, and that is hoarding beans, because it was actually a better asset to protect himself from inflation and exorbitant land and fertilizer prices compared to holding pesos. And so it's a fool's errand to try and do this. But in the short term, it did unlock a lot of soybeans, and the Rosario Exchange reported on Wednesday that they had their best day as of midday, I think, in 5.5 years. And so you've got Argentina, you've got the crop conditions not worsening here, and you've got these tropical systems now starting to look like they're going to help the soybeans. And when we saw the crop conditions report yesterday, actually the second number I looked at after looking at the conditions was what percentage were we dropping leaves in the U.S. Soybean belt, and it's only 10% versus 17% a year ago. So there's a lot of bushels we can still add in the good areas of the U.S. soybean belt if these rains come through. I would say, though, also clients in Nebraska and clients in Kansas and other drought-stricken areas are saying their beans are starting to turn. I even had a client in Kentucky tell me he didn't know if he was going to do beans or corn first, just because of some of the disease problems and the way they plant in that area. So the beans, to me, just continue to have more of a false bottom to them when I look at the supply demand. And then you add on top of that the mindset of the macros that you're talking about in these emerging markets that typically buy a lot of vegetable oil because they've got wealth and they've got strong middle income consumers that are ready to buy and eat a better diet, a more Western diet. That could unravel if we don't watch it closely.
Mike, let's talk the corn market a little more in depth as well. Low range closes Wednesday, but still felt like we held up okay. We maybe found, held some support a little bit. I think maybe traders are watching just closely headed into Monday with the upcoming September WASDE report, watching whether or not this national yield is going to go down. I think most people presume it will, but what's your thoughts in this corn market after all the wild, wacky action on Wednesday?
Yeah, I'm skeptical about USDA lowering the yield that much, and I think the acres are back on the table as well. That could be good for corn, but I'm, again, more worried about the beans and finding some extra acres up in the northern plains for soybeans. But when it comes to the corn, unfortunately, the corn continues to be tied to the wheat market and the soybean market. It hasn't found itself yet, and I'm wondering whether it's going to have to wait until we get past this report and even past most of the month of September and kind of get a feel for what is actually out there in the fields, Jesse. I get the sense that the trade is thinking that we're going to see a lot of bushels because corn harvest is going to be earlier, and they're going to watch the basis. And if the basis continues to weaken or widen as we get into the harvest, then they'll continue to pressure the futures market, especially if the wheat doesn't present us with support, and especially if the beans are the leader to the downside again. So I guess my basic point is, unfortunately, I think corn is still a follower, and unfortunately being overbought like the soybeans and going into harvest. I'm really eager if I could get one more push higher, and I thought I'd have it today, quite honestly, to close above 685, get to just around $7, get some bought puts in place in corn like I've done in beans heading into next week's report. That was kind of my goal. It still is. I'm not sure if I'm going to get it, though.
Well, it's something we'll be watching. Maybe we can find that Thursday or Friday. Let's move over to livestock, Mike, and I'll pull up the monthly live cattle chart on the video feed you sent me, and let's talk about cattle. When corn backed way off on Wednesday, I was kind of surprised. Cattle market really didn't rally all that well. So I'm wondering your thoughts with what you're seeing in the futures in cattle country and this cattle complex overall, Mike.
Yeah, this chart speaks to me because when I started in commodities, I started doing a livestock analysis and realized that the production cycles and the price cycles really were useful to know. And while the cycle low from low to low in the fat cattle price futures has tended to be 6 or 8 or 10 years, it's kind of narrowed down to 4 to 6 years now. And ever since 2002, Jesse, we've had typically a 4+ year cycle low in prices, and we last made our last low in 2020, and we're surging now in price action in the futures, even though the cash market really hasn't been developed yet this week, and it kind of closed weaker heading into the Labor Day holiday. So cash seasonals tend to weaken here, but I think we're running a little bit counter seasonally for this month of September just because of the drought and the ideas that supplies are going to tighten. But if I take a step back and look at this 4 to 5 year seasonal, it's saying to me or suggesting to me, be ready for a cycle high relatively soon, because this cycle, if it ends up being correct again, would suggest 2 to 2.5 years up, 2 to 2.5 years down. So that cycle's from price low to price low. So that's why at the far right of that chart, I've got a stop sign and a couple question marks. Can we break through the highs of 2021? We've done that. Okay, so now we've kind of unleashed the upside bull and let the funds run and the fund money run, but be really ready to get some hedges in place, especially for the fourth quarter where supplies are still going to remain fairly ample. Last thing I'll say is I think we had a good weekend for retail and the Labor Day. I've been surprised at how strong the consumers held up here, and I think that also is built upon the funds mindset.
This question as well kind of ties in with the corn market with basis when it comes to feed. One has to wonder how much feed is going to have to come from other areas into feedlot country as we get into this fall. So I'd have to think that's going to cause a pop at regional basis, but then also one has to wonder what that could do for the cattle market one way or another. I think that's an interesting situation to watch, Mike.
Yeah, real briefly, I'm really glad you brought that up because I actually have been really digging into the hay and the pasture, because I think it's going to become more and more important because these feeder cattle are still flying off the shelf in the cash market. They're still running, $200+ for 700-pound wean steers. I was watching a livestock auction today, and they just kept moving and moving and moving. I kept thinking to myself, well, is it because the hay and pasture conditions are good? No. Half the states out there of the 8 big states are worse than they were last year by a long shot. And the other 4 aren't doing that much better than they were last year. And I looked at the hay prices, Jesse, for Kansas and Nebraska, and good quality alfalfa right now. The range last year at this time was about 145 to 210. The range now for good quality alfalfa is 180 to 285. I think there's a real problem coming for the feedlot, for the feeders out there, and this fall calving season could be a really rough one if these prices don't hold up. So I'm really getting more nervous for the cattleman, the cow-calf guy especially, as he gets ready to decide whether he wants to market those feeders this fall as feeders or hold them as fats. And I think you're right to point that out because it really makes me nervous.
Hog market real quick. This cash index is taking a beating here. It's starting to come more in line with front month October hogs. But any thoughts in general with this hog market that you see right now as we move forward?
Yeah, flying blind on the export sales for another couple weeks. We're going to have to really watch China when we come back because I noticed their pork price jumped, and I think it's because of their earthquake and their drought. I was worried that the Sichuan province would see liquidation because they have blackouts essentially. What it looks like is happening is there's not enough pork moving, and between letting go on the state reserves by China and the pork price jumping, I think it was 5 or 6% this past week in some key areas. I think that Chinese pork market is going to really be a driver as to whether we stop the slide here and we start to see our cutouts jump again. So I'll be watching that between now and when we talk next week.
Well, Mike, fantastic stuff as always. Floor is yours. Any other final thoughts you have for us today?
I think the dollar's done a good job for us in terms of mitigating these big rally potentials in the second half of this calendar year. So I think it's still the key focal point of the market, and it really drives home what you were talking about the debt load of a lot of these emerging markets that have dollar-denominated debt. So I think that's the most wisest thing that was said about this week. Just stay on top of the dollar. If we get a high in the dollar, that opens up the upside in the grains, I think.
Well, Mike, if folks want to look at your research and look for some advice from you, I know they could reach you very easily on your website. How can they get a hold of you?
Just go to globalcomresearch.com, and globalcom with 2 M's, research.com. Sign up for a 2-week free trial. I'll contact you at the end of the trial and see if there's not something we can do with you, whether it's a subscription, whether it's cash marketing, both cattle and corn, or whether you want to open a brokerage account. So just realize the risk and the volatility in these markets as you make your decisions.
Well, fantastic. And with that, Mike Zuzolo, Global Commodity Analytics, thanks for the time as always, and we will talk to you next week, sir.
Thanks, Jesse. Have a great week.
Mike Zuzolo with us here today on Market Talk. That's going to do it for the show. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.